Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
And I'm Paul Allen. The top stories this hour. Asian stocks set for a lower open with solid US data and a commodity surge reviving that good news is bad news trade. Markets now expecting fewer rate cuts this year than the Fed itself.
Tesla's share rout deepening as first quarter sales miss estimates by the most on record, raising concerns about wider EV demand.
Plus, Presidents Biden and Xi speaking for the first time since November. The White House saying the TikTok sale push was on the agenda. All right, we're just open for trade here in Australia. Let's take a look at how we're doing in the early going. Of course, we do have a staggered open here, so difficult to get a comprehensive read on things, but we are higher by a 1/10%. One trend that we are seeing continue from what happened in the US, rising yields. You see there the 10-year just climbing a little, now 4.121. We saw this happen in the US, yields rising, bonds selling off, repricing of Fed rate cuts really going on. We'll talk about that in a moment. That US data just keeps on surprising to the upside. Here in Australia, we will have a bond sale today, $300 million worth of 2041 bonds at 2.75%. The oil price is another thing we're watching. That just keeps on creeping up as well. We saw US crude futures topping $85 today. First time that's happened since October. Of course, rising Middle East tensions simmering away in the background there. We'll have an OPEC Plus meeting as well later on today, and we're expecting the cartel to reaffirm its current production policy. Elsewhere, futures for the Nikkei looking kind of flat as we continue to watch the yen, Heidi, for possible intervention.
Yeah, and Paul, as you alluded to, this kind of idea of good news is bad news. We had better than expected data again out of the US, but also compounding the better than expected data that we've had out of China as well. So these two mega economies really contributing to this idea that maybe rates will stay longer higher than expected. So we're seeing a bit of that sort of coin toss scenario when it comes to whether the Fed moves in June at the moment, according to market pricing. Futures, when it comes to the S&P, pretty flat at the moment. We're hearing from Morgan Stanley as wealth management arm saying that the investor expectation is getting stretched, and that is a reason to seek opportunities outside of the S&P 500. They're saying steer clear of that overbought territory that we see for that market. Nasdaq 100 futures also looking pretty meek at this point. And Tesla, as we mentioned at the top, those sales that missed by the most ever. It is seen not just a blow for Tesla, but really a pretty brutal blow across broader EVs as well. Analysts slashing their projections in recent days, but apparently not by enough. We've seen shares for Tesla down still almost 5% at this point, but extending that 2024 sell-off that we've seen, one of the biggest drops that we've seen in the S&P, but first quarter coming as another one after another that we've seen from analysts reducing their estimate for vehicle deliveries out of Tesla, still managed to surprise to the downside. And of course, on the other side, we're also watching what Fed speakers have to say, right? In particular, we heard from the Cleveland chief, Loretta Mester, saying that they need to see more evidence of inflation. And that's really been that data dependence that we've heard from many Fed speakers. Take a listen.
I think that is a very reasonable baseline, but I would like to say here that this is a projection, right? 3 rate cuts is a projection, and a projection is not a promise.
I continue to think the most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence. Some further monthly readings will give us a better sense of whether the disinflation process is stalling out, or whether the start of the year readings reflect a temporary detour on the downward path back to price stability.
All right, let's get some more on this. Bring in Kerry Craig, Global Market Strategist at JP Morgan Asset Management. Kerry, we just heard there from Loretta Mester and Mary Daly as well. No real sense of urgency there. When it comes to rate cuts, we've now got July as the first month that's fully priced in for a Fed rate cut. But if this data keeps on surprising to the upside, if inflation stays outside the target window, do you think those expectations could get pushed out a little bit more?
Good morning. Well, I think that's obviously the market narrative that's gripping the markets today, is the idea that we have had the speakers from the Federal Reserve who have said we need more time, we need more data to assess, and they're going to get that. They're going to get 2, if not 3 CPI prints before the next meeting in June. Admittedly, that last one comes on the day of, but that should give them the confidence to see that that inflation trend is heading in the right direction, that they will see that projection that they have come into play, and that will allow them to start cutting rates. Now, whether it's June or July, I think that 1 month doesn't make a huge difference for the markets, and the fact that we'll be onto that rate cutting cycle. But I think there is a case for saying, well, maybe we do only get 2 rate cuts this year. Our base case is 3, but the Federal Reserve is hedging their bets there, saying maybe it's only 2 that'll come through when it does think about that dot plot. So I think a mid-year starting point for the Federal Reserve, that inflation that continues to come down in line with their forecasts, and that they will be looking at the developments in the economy and thinking they have effectively tamed inflation while avoiding that recession.
Yeah, that good news is bad news mantra really seems to start to get embedded again. But do you feel like in the 15 years since the GFC, do you think investors have just come to the conclusion that ultra easy policy, really low rates, is normal?
Well, there's an adjustment if they do, because we aren't going to head back to that era of ultra easy policy and low rates. There's a huge debate around where the neutral rate for the interest level is in the US economy, and it's likely to be higher. We saw the Fed very slightly nudge up their view of the long run interest rate back to 2.6%. In the past, it's been as high as 4%. So I think that idea that we're going to go back to those 0 lower bounds for interest rates or anything close to that is not something we'll experience now, given the outlook for inflation is going to be one that's more choppy, and we can see more structural drivers leading to higher and more volatile rates of inflation in the future. For us, this means that I think for asset allocations need to look beyond simply stocks and bonds for building that diversification into a portfolio.
Kerry, outside of the US, you're liking Japan. A lot of people are liking Japan. Where do you see the opportunities and I guess the next leg of this rally? And does the potential concerns over the yen add to some uncertainty for the equity rally?
Yeah, I think that obviously the weakness in the yen helps the exporters, but it's not simply an export story that's driving the market higher in Japan. It is about a lot of the structural changes, whether it's the corporate governance shifts at the TSE or thinking about, way back to the 3 years of Abenomics and how that supported the market. For us, we are seeing a shift in the economy that is a broadening out inflation and a bit better growth with that. We're seeing domestic demand start to come back through, and in line with the weaker yen, that's helping lift the market. So it is very much a market that is under coverage in terms of the stock coverage that comes from analysts. So it's very much a stock picker's market, and we can see upside to this. The yen potentially strengthening could be a slight headwind, and we might see some intervention come through from the Bank of Japan. But we're not going to expect to see a massive move in terms of a yen strengthening, given that yield differential between the US and Japan is a little bit more questionable now as the market started to price out some of those rate cuts by the Federal Reserve. And we don't think the Bank of Japan is going to go too far in terms of those rate hikes after moving away from that negative interest rate policy.
For China, a part of that, the good news is bad news narrative has actually been perhaps indicators that the bottoming out of the slowdown has taken place. Does that mean you're a bit more strategic on Chinese assets, and how would you play that?
When it comes to the broader Asian region, we prefer markets outside of China at the moment. You can look at the PMI numbers that came out overnight, the resumption of the manufacturing cycle. They indicated the fact you are seeing a pickup in new orders, and that new orders to inventory ratio is very favourable. That should feed into the more supply chain sensitive parts of the Asian region. That's Korea, Taiwan, Singapore to a certain extent. And outside of those markets and outside of China at the moment, the valuations obviously are very compelling when it comes to China. The actions by the government and the policymakers to at least try and find a floor under the economy and the market again should provide that stability. But there's still a lot of question marks around how strong that recovery will be, the reliance on consumption to drive that at a time when the property market is still weak, and overall some of the risks around regulatory shifts that could impact the market more broadly. So I think there's little ways to go for us to be more confident in looking at the Chinese market, but certainly the valuations being where they are will always keep us mindful of a watch there. But we're looking for a broader resumption in economic activity and more strength and resilience in their market before becoming more positive.
So valuations in China look very appealing, but are there other sections of the market, other assets elsewhere that are looking where valuations are looking a little bit stretched to you?
I mean, certainly it's going to be the biggest challenge looking at the economy itself. The broad macro narrative is one of the soft landing, if not seeing potentially a little bit of upside to that, given the economic data is beating on market expectations. So this idea that you could have a better economic outcome and rising profits in this environment, and I think that's being a little bit overlooked in terms of a more bullish case for the outlook for equity markets. Yes, valuations are high, and I think that would be reminisce to not expect to see some sort of pullback in the equity market if there was disappointment on that earnings outlook. And so that does mean we look for the relative valuation, whether it's in some of the market sectors outside of the large caps in the US, thinking about some of the more cyclical parts of industrials or even the energy sector, or even keeping a watchful eye when it comes to Europe, given the relative valuations there are looking more appealing. But again, waiting for more confidence that the economy is starting to turn, and will see those rate cuts come through from the ECB. So I think there's a range of opportunities globally, and definitely seeing that broadening out of the rally in the US gives us a little bit more confidence that the market can continue on this more bullish outcome than simply thinking about a bear market or a more significant correction in the near term.
Do you think that rally is at risk from the November election, and are there other geopolitical factors that you think risks might arise from?
Well, yeah, it's a year of heavy elections in 2024, and obviously the US election is front and centre on that. I think there's a degree of, not necessarily confidence, but there's a degree of familiarity given the two parties running, and obviously the two potential presidential candidates that are going to come through. Having relived this back in 2016, the market may have some degree of familiarity, which is keeping them a little bit less risk adverse at this point in time. It's also some way off. I mean, we are only getting sort of early indications of what the policy dynamic may be. And then again, the split in terms of who has the majority in the House or who has the majority in the Senate, as well as who is leading the White House, will actually have a big impact on that policy outlook from here. So I think the market will probably pay more attention the closer we get to that November election, but it's more a case of thinking about the outcome of the economy, or the outcome of the election is probably not the biggest impact on the market, given that it's more important where the economic cycle is for thinking about earnings and profits, and the policy changes may not be as severe as many people are concerned about.
Kerry, always great to chat with you. Kerry Craig, Global Market Strategist at JP Morgan Asset Management. Well, still ahead, we take a closer look at what's behind Tesla's big miss on first quarter deliveries and how the EV pioneer may be able to turn around sentiment. But before that, we get the details on that Biden-Xi phone call, with Beijing staying silent on Washington's claim that they talked about TikTok. This is Bloomberg. President Biden and his Chinese counterpart Xi Jinping have spoken by phone in their first one-on-one communication since November. Bloomberg's political news director Jody Schneider joins us now from Washington. So Jody, tell us more about this call, what was discussed, and I suppose, moreover, the significance of it happening at all.
Yeah, I think, Heidi, that last part is the most important part, that it occurred. A bit of a surprise. We only really knew shortly before the call took place that the two men would be talking today. It is their first one-on-one since November, so quite a long stretch. And, of course, the temperature has kind of dialed up often between the two countries in terms of things like national security issues and the issue of Taiwan, also the industrial base, something that Janet Yellen will be talking about when she goes to China later this week. But the call, they said, was candid, constructive, and the fact that it happened and that it looks like they want to continue these kinds of conversations. And it happened in advance of Janet Yellen, the Treasury Secretary, going to China this week, and Anthony Blinken, the Secretary of State, going shortly after Janet Yellen. This is significant that they want to really cool the temperature and also to try to find some areas that they can agree on. One is stopping the flow of illicit drugs like fentanyl. Another is climate change. Of course, they're far apart on many other issues. But again, that fact that they got on the phone and they talked to each other and both readouts of it were pretty cordial is a good sign that at least they are talking to each other.
Yeah, plenty of areas of disagreement, though, Jody. Among them, the TikTok divestment. Did that come up?
Well, the U.S. said that it came up. John Kirby, a White House spokesman in the White House briefing today, said, yes, TikTok did come up. He said that President Biden brought it up, not as an issue of banning it, but as an issue that they want it to be divested, that they don't want to see China owning it anymore. The House, of course, the House of Representatives has passed a bill that would require the divestment of it by China, by the Chinese-owned company ByteDance that owns it, or there would be a ban. That has not gone forward in the U.S. Senate, but there is a lot of support for it among lawmakers and support by the Biden administration. The Chinese version of their statement about the phone call did not mention TikTok.
Jody, do we think that anything specific and tangible will come from this conversation?
Again, Heidi, I think that there are areas that they would like to say they can move together on. Fentanyl is one, really trying to take steps against the illegal flow of drugs globally. There are some other issues that they keep talking about, trade, but of course tariffs is then a difficult part of that. I don't think we'll see anything concrete come out of this. The U.S. has to decide what it is going to do soon about tariffs. But the fact that they had this, and this leads up, and it lead up to Janet Yellen going there, where there could be some economic policy discussions that could lead to some concrete kinds of steps that two countries can take together.
Yeah, that visit from Treasury Secretary Yellen, that's happening later on this week. What's going to be the focus for her, and what's going to be her message?
Yeah, so she's going to go to Guangzhou. She's going to basically really look at some industrial plants. She's going to speak at the American Chamber of Commerce in Beijing. She's going to speak to students there as well. And her message is going to be somewhat of a tough one, basically saying that she is worried about overcapacity of industrial overcapacity in China and the effects that could have on the global economy, a statement she's made many times before, but she'll be making it directly to leaders. Yet on the other hand, she is viewed as someone that the Chinese officials like to deal with. They know her. She's been there before, just a few months ago, and they can talk about the economy with her. China had several major American business leaders in China just recently, just last week, and those meetings seem to go well. Given China's economic woes, this seems to be a time they want to talk to people about the economy and seeing ways they can move forward. So even Janet Yellen with a tough message will be, I assume, welcomed pretty heartily in China.
All right, Bloomberg Political News Director Jody Schneider there in Washington, D.C. Let's take a look at some of the other geopolitical stories that we're following. The White House is calling for accountability after Israeli airstrikes in Gaza killed 7 aid workers. Among the dead are British, Australian, Polish and Canadian American volunteers with the World Central Kitchen charity. Israeli Prime Minister Benjamin Netanyahu admitted what he called an unintended strike on innocent people. It's prompted several charities to suspend food deliveries to Palestinians who the UN and EU say are on the brink of starvation. Iran's supreme leader has promised to take revenge on Israel after a deadly airstrike on its embassy in Syria. State media quoted Ayatollah Ali Khamenei as saying Israel will regret its crime. Israel's not confirmed that it was behind that strike in Damascus, which Tehran says destroyed its consulate building and killed at least 13 people, including 7 Iranian military personnel. NATO is said to be proposing a fund of allied contributions for Ukraine worth $100 billion over 5 years. Sources say it's part of a package alliance leaders would need to sign off on when they gather in Washington in July. The proposal could also see NATO take charge of weapons deliveries to Ukraine amid European concern that a second Trump presidency could change US policy. Now you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to Daybreak Go. It's also available on mobile in the Bloomberg Anywhere app, and you can customize your settings so you're only getting the news on the industries and the assets that you care about. This is Bloomberg. Wasn't a very good day for Tesla, was it? Let's run through some of the numbers. 386,810. Well, that's how many Tesla cars got delivered in the first 3 months of the year. It was a massive miss. I mean, we were estimating 400 to 420,000 and thought that was conservative. So, yeah, punishingly bad numbers, and the share price responded accordingly.
Well, that was the thing, right? Leading up to this, we had cut after cut after cut in expectations for analysts, but apparently they were still kind of too optimistic in the end in terms of what we finally saw. And it will be interesting to see whether this kind of contributes more broadly to weakness across EVs, right? Lots of factors that Tesla blamed: production, logistics, the refresh of the Model 3, the blackout that happened near its factory in Berlin, and shipping disruptions in the Middle East as well. But still, if you take a look at the numbers for production, still outpacing deliveries by the widest margin yet, more than 46,000 vehicles. So it's now been producing more cars than it's sold in 7 out of the past 8 quarters. So it doesn't seem to be a production or logistics related weakness that we're worried about here.
Yeah, plenty of excuses on the supply side. I guess the question is, does the market buy this? And I mean, Elon Musk said before that Tesla's in between these 2 waves. It's just a question of how big is that trough between the 2 waves. And I think a lot of market watchers are holding their breath for something new from Tesla, maybe the Model 2.
Yep, and you talk about the wave, and the wave of Chinese supply is just crushing, right? We've been talking about the weakness that we've seen in the China market at a time when a lot of these producers, including the newcomers like Xiaomi, but certainly the huge discounting that we see with the likes of BYD, really putting pressure on Tesla, which has just increased its prices in China. But March really shaping up, on the other end of the spectrum as a really strong month for Chinese EV makers. Several reporting double-digit sales gains now. It was a slow start to the year due to, of course, the combined impact of the seasonal holidays. But BYD sales jumping 46% on year there. We also saw Li Auto, NIO and Xpeng, all listed in the US, of course, surge in deliveries that ranged between 14 and 39% in March.
Yeah, we'll get a bit more commentary on this Tesla story in the next hour. I think Dan Ives is going to be joining us. Gee, he's on fine form. He called this an unmitigated disaster, a train wreck into a brick wall. So stand by for what could be a pretty interesting conversation.
Yeah, we'll be getting some more analysis on that too. I should mention Rivian numbers also beating expectations as well. 2024 output target being kept at 57,000. So it seems like there's good news across that space if you're not Tesla. Let's take a look at some of the corporate developments that we're tracking as well this hour. Toyota and Honda, speaking of autos, notching big US sales gains to start the year. General Motors grew their retail deliveries, demand for cheaper cars, helping automakers defy expectations of a broad slowdown. Those early results really underscoring the importance of affordability for car buyers after the pandemic-driven shortages and high interest rates driving up costs. Bloomberg has learnt that Disney management is pulling ahead in its proxy fight with activist investor Nelson Peltz. Sources say Disney's biggest investors, Vanguard Group and BlackRock, will vote for its slate of nominees at Wednesday's board meeting. It is a major boost for CEO Bob Iger, who's looking to stave off a challenge from Peltz's Trian Fund management over leadership and strategy. The United Steelworkers Union has dismissed a letter from Nippon Steel committing to spending and job protection as a meaningless piece of paper. The Japanese company had been trying to bolster support for its planned $14 billion takeover of US Steel. President Biden has said the US company should stay American-owned. There is plenty more to come here on Daybreak Australia. This is Bloomberg.
The teams have been working a lot since November on fentanyl precursors, on climate change, on economic practices. So there's been, on artificial intelligence, there's been a lot of staff level work, and both presidents thought that now, a few months later, this was a good time to kind of check in with one another, see how that's going, discuss the future.
That's National Security Council spokesman John Kirby speaking about the phone call between Presidents Joe Biden and Xi Jinping earlier today. So let's bring in Anna Ashton to talk some more about this. She's the founder of geopolitical consultancy Ashton Analytics. Anna, you've noted that there were no real surprises out of that call, but was this conversation really more about stopping things from getting worse, keeping the relationship going, rather than helping it actually improve?
Oh, I think that the entire policy of engagement is largely that the Biden administration embraced, in spring of last year, is largely about stopping things from getting worse, precisely. And the hopes that things will get better, better in terms of maybe more stable, more predictable, less volatile. But better does not mean, more robust engagement in trade and cooperation on commercial issues. It certainly doesn't mean that.
Yeah, well, we had a description after these talks that they were candid and constructive. Certainly the problems in this relationship are well known, but can you talk to us about the constructive part? What was the good news to come out of this?
Sure. Well, I mean, first of all, it's good that the policy of engagement that the Biden administration launched last spring is continuing. It clearly has produced a bit more stability. And, some of the things that the White House has raised with Beijing as priority issues for the United States have seen follow through from Beijing. So, for example, Beijing was avoiding senior level military to military engagement, but we've seen multiple meetings since last November that have made progress on that. And we have news that Secretary of Defense Lloyd Austin plans to go to China at some point this year. In addition to that, there's fentanyl. There was definitely movement from the Chinese side to crack down on producers of precursors to fentanyl who were shipping to illicit buyers after the November talks. And then, there's upcoming efforts to have a bilateral dialogue on AI risk mitigation, which, it's refreshing to see that both sides have found something like that is, pressing and potentially significantly disruptive to countries everywhere that they want to work on despite their distrust of each other on so many fronts.
We understand that TikTok was raised in the conversation, although Beijing has made no mention of it from its side. How big a deal of this do you think this is for Xi in particular?
So, I don't really perceive Beijing as likely to step in to save TikTok if indeed the policy on the U.S. side ends up being a forced divestment or divestiture. I think that if China was going to do that, they probably would have done it when TikTok was facing a ban in India, because there were more users in India than there are in the United States. And they didn't do that. TikTok is not part of the strategic tech industry that the Chinese government is focused on really building out. And it won't stop, TikTok's China platform from operating. I do think that the U.S. agitation over TikTok is symptomatic of this broader distrust about Chinese cyber activities, whether that's hacking or embedding malware in infrastructure or stealing data. And that's going to continue to be a problem, really, as the two sides' distrust deepens. I think that problem is only going to increase.
You say that distrust leading to de-risking policies, leading to the broader decoupling that we see across tech and security. Does any of that change? And in fact, what changes, what potentially worsens depending on the outcome in November in the US?
It's so hard to say. I think we saw a Biden administration that in its first 2 years was very focused on rebalancing the trade relationship, getting rid of the bilateral trade deficit. And there have been plenty of suggestions that that focus would be reinvigorated. I mean, it hasn't really gone anywhere. The tariffs have been kept in place by the Biden administration, but, would we see an increase of those tariffs? I think that there's a fair chance that we would. On the other hand, it's harder to tell exactly what the Trump administration might do on other aspects of the relationship. Would they dismantle the dialogues that have been sort of restarted? Maybe, maybe not. I don't think we've had any clear indication from Trump either way. Would they be anxious to to step up defense of Taiwan and be more emphatic about the U.S. position that Taiwan is a democracy, or to declare Taiwan as independent. Maybe, or on the other hand, Trump being somebody who prides himself on being a businessman and has a history of being transactional, perhaps it could go completely the other way if there's an opportunity in his mind to make progress with China on issues that the U.S. cares about.
Yeah, unpredictability, certainly a byword when considering a potential second Trump presidency. But let's just zero in on one possible variable, and that's chip restrictions. Xi Jinping saying that he's unhappy about endless restrictions and sanctions on China's tech sector. I mean, could things potentially get even tighter after November?
I think they could, yes. I mean, I think there's a lot of bipartisan support for those restrictions and for those restrictions to be ratcheted up. I think that we've seen, though, that China's response to that has been to double down on its own efforts to try to catch up technologically, to try to embed its technology in other markets worldwide and make it harder to avoid. And I think that as the U.S. tries to step up its restrictions in order to protect U.S. competitiveness and protect U.S. national security interests, China is going to continue to see that not as really about protecting U.S. competitiveness, but as pushing China back, setting China back, and trying to keep China from catching up or meeting its own technological goals, its own economic goals. And so China will both continue to double down and throw subsidies towards industries that it wants to see advance more rapidly so that it can compete better, and also engage in retaliatory actions where it views those actions as helpful. So, we've seen, for example, some export licensing restrictions rolled out on certain critical minerals. We could see more of those. We could see those restrictions implemented and enforced in a more stringent way. And certainly, that's a vulnerability for the United States that it can't overcome in the near term because the U.S. is quite reliant on China for a lot of critical minerals and certainly the processing of them. So, this could hurt U.S. interests, certainly.
Anna, always great to have you with us. Anna Ashton, founder of Ashton Analytics. We get more developments when it comes to US-China relations, and a new poll suggests China has dethroned the US to become the top alignment choice for Southeast Asians. The survey of just under 2,000 people by Singapore's ISEAS Yusof Ishak Institute saw China's popularity climbing to just over 50%. The report says that waning confidence in the US could be attributed in part to anxiety about Washington's strategic and political influence. The US is said to be asking South Korea to adopt restrictions to chip technology exports to China in line with Washington's controls. Sources say officials want Seoul to tighten the flow of technology used for making high-end logic and memory chips. The US reportedly discussed the topic in depth with Korea's president in March, but Seoul is still debating that request as China is a key trading partner. Well, you can watch us live and catch up on past interviews. It's our interactive TV function, TV Go. There you can also dive into any of the securities or the Bloomberg functions that we talk about and join in on the conversation as well. You can send us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. It's at TV Go. This is Bloomberg.
The Japanese are fighting a losing battle, and they might as well give up. There's no way that they're going to do anything to strengthen the yen, and it'll probably continue to weaken.
It remains to be seen whether we can have that effect. So yes, the key is that we see broader sort of dollar weakness happening.
If we look at the Japanese central bank, they're still printing money. Right? They're still keeping a very, very loose monetary policy, even though they're saying, oh, actually, we're making changes in our interest rate policy, but it's compared to the Fed, it's still, there's a wide gap.
My experience in the past with the Macquarie in the 90s, I understand when you have weakening currencies, your local stock market tend to do very well.
Financial stocks in particular, I would mention, I think these are the promising ones within Japan. On the margin, probably exporters a bit less so.
Some of our recent guests there weighing in on the yen, and for more on this, let's bring in Garfield Reynolds, leads our Markets Live Asia coverage. Garfield, we heard Mark Mobius there saying, well, it's a waste of time trying to defend the yen. We've got Bank of America saying it's got the yen at 160 unless the Fed cuts. So does that sort of indicate that this is to a large degree out of Japan's hands?
Well, yes and no. After all, they did plenty of jawboning recently, and the yen pulled back from 152, so they've drawn a line in the sand, extend the analogy and say, difficulty is US economic data is so strong that the rising tide threatens to completely obliterate those and other lines in the sand. So in the short term, and especially tactically, Japan has some potential to, restrain the declines. And let's face it, in a lot of ways, that's what they're fighting to do, is restrain the decline. I think they would acknowledge that there's limits to what they can do precisely because of the policy divergence, but that doesn't mean that it's not worth doing, because of the concerns that, if it breaks rapidly above, if the dollar breaks rapidly above 152 yen, then yes, it could go to 160 or so in a heartbeat. We've seen the yen really motor, if it gets a full set of green lights. So I think that also maybe even speaks to, not directly, but the Fed's unwillingness, the Fed speaker's unwillingness to look at the really strong data we've had lately and say, you know what, we might only cut twice, we're not sure, but they're sticking with that 3 cuts. I think that's partly an acknowledgement that on a range of issues, they're concerned that if they make that step, that will cause turmoil in their own markets and elsewhere, and will act to effectively tighten policy both at home and abroad in ways that they're not necessarily ready for.
It's not just the yen. We're seeing sort of weakness across a lot of Asian currencies, not to the same extent, of course, but the yuan is one of them. And I do wonder, in that environment, does it benefit Beijing to lean into that weakness?
Well, it creates a lot more problems in many ways for the Chinese authorities than it does the Japanese authorities. Japan's got a comparatively straightforward set of monetary policy settings and a clear path where they've ended negative rates, and in the future they would want to move at some stage to actually raise interest rates. But the PBOC has a whole range of levers that it's busy adjusting and tweaking. It's got an economy that is showing some signs of turning around, but is still pretty weak. And the yuan complicates all that, because in many ways a weak yuan would help to ease conditions in China, would help to stimulate the economy, but not if it gets weaker than about where it is, and again threatens to run away. They've got even more interest. Their official policy is to restrain the yuan to no more than 2% either side. So that creates a very tough setup for the PBOC, especially this week is a short week for China. They're off on Thursday and Friday, so that means there's no fixing on Thursday and Friday. You've already got a wide gap between the onshore yuan and the offshore yuan. So that's a currency that really threatens to steal the spotlight for Asia in the coming days, because of the weight that China's economy has for a lot of Asian partners, and also it is one of the most traded currencies, especially in Asia. It has a lot of influence over the Australian dollar, for example, and then knock-on effects elsewhere. So in many ways I'd be keeping an even stronger focus on the yuan than the yen going into this week, and I'd be concerned for the potential that turmoil to either side for the yuan could set off some severe reactions across Asia and even beyond.
Garfield Reynolds, who leads our Markets Live Asia coverage. Let's talk a little bit more about the impact of the weaker yen on Japan's consumer sector. With us now is Nobuko Kobayashi, Asia Pacific Strategy Execution Leader at EY, where she advises C-suite clients in the consumer industry, both from Japanese and multinational companies' perspectives. Really great to have you with us. So I guess to start off, what has been the biggest impact when it comes to these big downside moves that you've seen in the currency?
The downside move has certainly helped the export-oriented companies, the big companies who have the global footprint. So this has been the underlying factor for the market rally that we've seen in Japan. It's been up by 20% by Nikkei average since the beginning of the year in the first quarter. So it's been supportive for that. At the same time, the yen depreciation is negative for the imports, and people are suffering from the inflation that we see. CPI is about 3% increase year over year.
What has it sort of meant when it comes to confidence and sentiment, right? Are your clients sort of gauging that? Because we have seen the weakness in the currency really have an impact for households and their spending capabilities.
Right. There is a weakness in the spending. The spending is a very subdued level. It's not at the level of the pre-COVID yet, and this is impacting the domestic companies' confidence level, whereas the overseas demand is very pulling up the performance. So this is a concern, but we think that the domestic consumption and the domestic economy will bottom out as early as second half of the year. And this is due to the wage hike that we've been seeing positive move, 5% plus increase as a result of the spring wage negotiation. The Japanese people are not used to inflation, and the wage hike has not yet caught up with the inflation that we're seeing. But as people get more comfortable about the sustainability of the wage growth in the real term, not just nominal, and be comfortable with this inflation at the mild pace that we haven't seen for the past decades, I think the consumer sentiment will also bottom out and ameliorate.
Something else Japanese consumers might not be used to is the ability to actually earn interest on their savings. Do you think there's a chance that some of this money just could be salted away in savings accounts?
That will be a change to see some interest rate positive on the savings account, yes. And that is a positive factor for the people's sentiment. At the same time, people also borrow. So on the mortgage rate and so forth, people will start seeing the increase in the rate as short-term prime rate will change. So that will be kind of a balancing act. At the same time, the government is encouraging consumers to invest. So there is a program to encourage retail investors to invest more. So this will be a new phenomenon for Japanese population as well.
Well, we're going to be hearing from some of Japan's retailers. We've already heard from Fast Retailing with results yesterday. Some interesting detail in there. They've got fewer customers but a higher average spend. So can you make sense of that data for us and what this coming spring and summer is going to look like for Fast Retailing?
Sure. For the fast retailing and the fast apparel giants such as Fast Retailing, their domestic sales is very much influenced by the temperature because their market share is already high and kind of tapped out. So the March saw a decrease over a year of existing outlets revenue by 1.5%. This is largely attributed to the cold spell that we had in March. So people were discouraged from buying more for spring fashion. At the same time, people were buying more of a winter clothes, which pushed up the average spend per capita.
All right, Nobuku Kobayashi, Asia Pacific Strategy Execution Leader at EY. Thanks so much for joining us. Just want to get you across some lines that we're hearing from President Biden on the Bloomberg terminal at the moment relating to the conflict in Gaza. President Biden saying that Israel's not done enough to protect civilians, and he says they must continue to press Israel to do more to facilitate aid. And this comes on the heels of those 7 aid workers killed in an Israeli strike. Israel has since admitted fault and contrition as a result of that. But President Biden saying we will continue to do all we can to deliver aid in Gaza, but really tightening up the rhetoric on Israel there, saying it's not doing enough to protect civilians. More ahead on Daybreak Australia. This is Bloomberg.
All right, take a look at how we're tracking. We're just about an hour or so into the start of trading here in Australia. We're seeing quite a bit of sustained weakness, all except energy and utilities showing the only leadership as we continue to see that strength being sustained across crude prices. We're seeing energy stocks up by just about 1% across a broadly weaker market. We're also seeing a little bit of upside for materials as some of that money piling back into commodities on these now repriced expectations with the better data that we've seen out of the US and China, that perhaps rates more globally will stay higher for longer. In terms of Japanese equities, we're also seeing a bit of weakness as we get into the start of trading there. We're still watching that yen volatility at levels just under 152. Of course, that is where we see the prospects potentially of intervention. We have seen, of course, more pretty regular bouts of jawboning from authorities in Japan, Paul.
Yeah, let's take a look at some of the stocks that we're going to be watching when trade does open at the top of the hour in Korea and Japan. Keep an eye, of course, on supplies of Tesla and EV batteries. This is after Elon Musk's company reported first quarter deliveries that missed estimates. And one stock on the radar, LG Energy. It gets 18% of its sales from Tesla. And rival car makers, of course, such as Toyota, Nissan and Hyundai, they're going to be in focus as well following that Tesla miss. And we're going to have more analysis on Tesla's first quarter deliveries next hour with Wedbush Securities Managing Director Dan Ives. He certainly didn't hold back in his assessment of that big miss on deliveries. OCBC Bank is going to be joining us as well to explain why they remain constructive on the medium-term outlook for stocks. All right, we've got those markets opens in Seoul and Tokyo coming up next. Stay with us. This is Bloomberg.